Thank you, everybody, for coming. Really good to see you here, and hope you're having a great time at VRIC. Excited to be doing this chat. Going to be going over what's going on with the gold price and gold stocks. I thought, though, I think probably many people will be familiar with you and your work, but maybe just a brief intro to what you do, because I know you're very focused on charts and technical analysis.
Yeah, thanks, Charlotte. So my background is a little bit different than most people here. I started my career in the intelligence analysis field for the military. I spent a year in Iraq and Afghanistan. I did spend a year at CIA headquarters in Washington, D.C. And so you might think, well, what does that have to do with financial analysis of the markets here? And really, the takeaway is that when I was on the front lines, I had military commanders coming up to me and saying, Christopher, is there a good guy or a bad guy on the ground right now? We need an answer, and depending on what you say, we're either taking action on this target or not. There wasn't a whole lot of time for getting into a dozen or 2 dozen different points, data points, all this. It was, what is the answer? We're going to be doing that. And so I compare that to technical analysis of the financial markets. Technical analysis basically means we focus on the most important thing in the markets, which is the price of the asset that we care about, right? So we're either talking about the price of gold, we're talking about the price of silver, we're talking about the price of the GDX, the mining stocks, maybe we're talking about the price of the individual miners. That's what we care about ultimately. We could spend all day talking about 100 different fundamental data points. I can have that conversation with anyone who we want to have that conversation with. We could talk about mining supply, hedge supply. We could talk about manipulation in the markets. We could talk about, what the US dollar is doing. But I say all of those fundamentals get boiled into one single data point. And that data point is the price of the asset. Every single human being, every single central bank, every single hedge fund, investor, fill in the blank, manipulator, yes, even the M word, they all converge on the price of the asset. What we're going to talk about today is price of the mining sector, price of various ratios, price of various assets, and we'll go from there.
Yeah, that was a great intro to yourself. I think knowing your background, it makes a lot of sense why this is the approach that you take. So as you mentioned, we've got some slides to go through today, and I believe the first one that we're going to be looking at is gold and gold stocks since 2006, how they've performed.
So let's get into this. This is the 800-pound gorilla in the room that frankly, probably not 1 out of 100 people who are attending this conference or presenting at this conference want to talk about this chart, but it is the single most important chart for every precious metals investor here. By the way, we invest in other commodities as well at iGold, but the primary focus on this time on precious metals. On the top, we're looking at the senior large cap gold miners, the GDX fund, since the inception of the fund, 2006. On the bottom, we're looking at the price of gold. Okay, this is the metal, and these are the companies that dig the same metal out of the ground. There should be a relationship between the metal and the companies, right? Okay, so take a look at this chart. Start to notice some differences with me here. We've got that 2011 top on both the GDX and the price of gold. Big drawdown, 2011 to 2015. As a side note, I started to publish in 2015. I don't get everything right. I got that one call pretty good. 2015, we start the up move. You can see from 2015 through the present, gold is higher than it was at the 2011 peak, and the gold miners are lower. What's wrong? What's wrong with this picture here? Now, this is not going to be all doom and gloom, the end of the sector, but if we want to have a frank discussion about this, this is what we need to talk about. Gold miners are lower. Not only that, you look at points 1, 2, 3, and 4, roughly equal on the price of gold, just below that 2075 level. What do we have for the GDX, making lower and lower peaks? So this is, I hate to say it, and if this is the last time that I'm invited to this conference, I'll say bless everyone, but I have to speak what I see in the markets, which is this is egregious underperformance from the entire mining sector relative to the metals itself. Now, there is going to be a silver lining to this when we go a little further. But this is the backdrop that I want people to be aware of. This is what we're going to be talking about the rest of the presentation.
It is, and I'm so glad that we were able to bring the charts here, because I find that it can be a little bit confusing, but if you see it together like that, it starts to make a whole lot of sense. And I think our next one is going to be on the Dow to gold ratio, which you told me was quite important. So looking at the history and what that tells us about perhaps what's coming.
Yeah, exactly. So, various individuals are trying to look for reasons. Why is the mining sector, why are the gold miners underperforming the price of the metal so much? I hear all sorts of reasons being given. Costs are going up faster than the gold price. Inflation, labor strikes in South America, yada, yada. All these reasons. In my opinion, based on the study of price, this is the single most important reason why that underperformance has been happening. We are looking simply at the price of gold and the Dow Jones Industrial Average. This is the 5,000-year store of wealth and the top 30 industrial stocks in the world. Why are these two things basically mirror images of one another? Why is it that when the price of gold is going higher, the Dow Jones is going higher, and same thing vice versa? So this is what it is. Let's zoom it out one more moment and let's look at this from a slightly wider perspective here. Same Dow to gold ratio on top. We're just looking at now as a ratio format, as opposed to one asset and then the other asset. We're looking as a ratio, Dow to gold. So this is simply the number of ounces of gold that are required to purchase one share in every company in the Dow Jones. And you can see that over the last 9 years, this thing is 100% flat. Actually, now as we're speaking, it's slightly higher in favor of the Dow compared to where it was in the beginning of 2015. So flat to slightly upward in favor of the Dow, even as what? The price of gold has doubled. So if we have a ratio that is flat while the price of the underlying asset has doubled, that is telling us that the Dow Jones Industrial Average has also doubled at the same period of time as gold has doubled in price. And this is the single most important reason, in my researched opinion, why the gold mining sector is underperforming the metal so much. I want to zoom this out one more level, and so you can see how important this is. Now we're looking at this is it. There's no more data to refer to here. This is the entire freely traded gold history. Dow to gold ratio going back to 1970. Gold began freely trading in 1971 when, of course, Nixon took the US dollar off the gold standard. Below it, you're looking at the price of gold. So what you can see is every previous cycle in which gold has been in a bull market, that Dow to gold ratio has strongly compressed lower in favor of gold. Gold rises, Dow to gold ratio compresses, meaning gold is outperforming. The only exception to that is the period that we've been living through for the last 8 years. So we are living through some sort of an anomaly in gold price action. And if you think about what this does for, let's say, the average investor, right? In the United States, we have 401k funds. Here in Canada, you have the tax-free savings account, self-directed. Australia, they have similar, superannuation funds. You think about what this does to the average investor, who, yes, as the price of gold has doubled, that average investor has done just as well in their index funds compared to the price of gold. So the average investor sees no reason to diversify into the precious metal sector as long as that Dow to gold ratio is moving flat, which it's done for the last 9 years. Stark contrast comparison to the previous 2 cycles in which in each of those instances, gold investors would have been rewarded for taking some of their funds, even if someone was only going to take 10 or 20% of their retirement funds and move it into gold. You multiply that by a few hundred million people around the world participating, that's where you get that speculative interest coming into the gold sector. And some of that money flows into the gold and silver miners. And that is what we have not seen this round. This is why this is so important.
Yeah, so great look at the broader context there. Thank you for going into that. And I believe before we get into the present, we're going to take a look back at performance of some gold and silver stocks in previous times.
Yes. So this is not all doom and gloom. The sector has been through a rough period here over the last 8 or 9 years. I have my pulse on this market. We publish research, I publish articles, I speak to investors. The sentiment has been very down recently. However, there are some comparisons here when we look at history of times in which this has happened before. And if you think, well, gold has made 4 attempts to break out now above the 2075 figure, right? I'm just going to tell you, I've been studying the markets from a technical basis, again, that price basis. I have never seen a market make a quadruple top over a long-term time frame. I mean, if this is going to be the first time where gold tops after making 4 attempts at 2075 and doesn't break out to the upside, it'll be the first time that I ever observe it. I'm not saying it can't happen, but it's extremely rare. So, I mean, if we're looking at that and then we're saying, look, so gold has a significant chance of actually breaking out, even despite that underperformance from the mining sector. Gold could actually still break out, get to 2,200, 2,300, maybe even 2,500 within the next 2 to 3 years. Maybe that represents a final top when we get to that point. But even so, I just want to show you a few examples of times like this, where if someone has the proper risk to reward tolerance, you might want to allocate some capital to some of these gold miners that have been so beaten up. You saw the underperformance when we first started talking. This has happened before. There can be radical periods of outperformance in the mining sector, even after that underperformance. And so this is why I'm still investing myself in the sector. And when I work with individuals, we're still taking some positions. Just look at this correlation here, right? Gold on the top, Anglo Gold, large cap gold miner, very similar to the GDX fund, 1971 to 1980. Notice how when gold was flat over the course of 4 years, completely flat below that black dotted line, where was Anglo Gold? Down 70%.
Sorry.
I mean, what the heck is going on? You have the price of gold even, but the gold miner is down 70%. Sentiment, right? Gold investors, and I'm not blaming anyone individually nor anyone in this room, but as a sum, all of us, we get tired of following the gold market when it's moving sideways. And so we had this period of time in the 1970s, gold was moving sideways for 4 years. This large cap gold miner that produces the very metal was down 70%. And then who ended up being right in the end, at least in the final wave? You look at after gold broke out, and then Anglo Gold was up 500% in the last 15 months of the move. So this can happen.
And this is a big company.
This is a huge company. This would be equivalent to that GDX, that GDX fund. Which didn't exist back then. And then if you think for some of the junior gold miners, we'll talk about a few of the companies that we've invested in here in a moment. A few of the junior gold miners, if you have the large cap companies going up several 100% at the end, the juniors have the chance, for someone who has the proper risk and reward tolerance, I mean, they have the chance for life-altering gains in the final wave. But you've got to be appropriately positioned for your own risk tolerance.
Yeah, definitely. This is very telling because we always hear that the large companies don't see those large moves. This is huge. So let's take a look at what you're looking at right now for the present, because I think everybody wants to leave with some actionable advice.
Yeah. You know what? There was one other little example here. I mean, let's just look at this really quickly so you can see that that's not an isolated instance that I picked out of the hat there. Here we have the price of silver on the top, same time period. Look at the peak that silver made at about $6 per ounce in 1974. It took 4 years to consolidate. Look at Hecla Mining. Hecla still exists today. I'm not sure if they're here presenting today. But Hecla was down 85% as the price of silver was flat. What is this? I mean, it's crazy, the sentiment swings in this sector. But if you can take advantage of companies that are down 85%, even when the metal is flat, you have these chances. You know, Hecla then went up 1,000% as silver broke out. Let's look at, okay. So we have this same setup, right? We were pretty much just looking at this in the 1970s. You've got the price of gold completely flat, once again, and you got the GDX down 40%. If gold makes a final wave, or not a final wave, but if gold breaks out to new all-time highs, it's been flirting with it 4 times here over the last 4 years. If gold is in the leadership role here, not only could the GDX, could these large cap miners break out to the upside, but you saw what some of the large cap companies did in the 1970s. Let's look at two. These are just 2 ideas. These are companies that my group of investors have taken positions in over the last year for exactly that reason. We'll pull up a couple of charts here. The first company is Bravada Gold Corp. This is the most speculative end of the sector, so you have to have the appropriate reward and risk profile for this. I like the companies with defined assets in the ground. To me, that's the sweet spot. It's like low-hanging fruit. You know, I mean, I love exploration as well. We own some exploration companies. Production is the lifeblood of the industry, but in my opinion, the sweet spot are the defined resources in the ground that are selling for a fraction of the price that they were selling at just 6 or 7 years ago, with gold prices now higher than they were then. So, you know, one company I like is Bravada Gold Corp. They've got 1.2 million ounces of gold politically safe in Nevada, United States. They got no debt. They've got an experienced management team. The Mannix Group runs several different companies, Southern Silver, Equity Metals Corp. These guys have been doing it for decades. So you've got the gold in the ground there. It's just this is selling at 1/10 the price that it was selling at 6 or 7 years ago. So you do have a reversion possibility. I mean, what would the numbers be? 1,000% to get back. I'm not saying it's going to happen again. This is not a guarantee. There are no guarantees in the investment world. But if someone has the appropriate reward and risk tolerance, these are the home run opportunities. This is what I like personally. One other example, Sirius Resources. We took a position about 1.5 years ago in Sirius, and we're still waiting. The move hasn't happened yet. I mean, if the move had happened, if this chart was already up where it was a few years ago, I wouldn't be presenting it to you. Quebec, I love this jurisdiction. You've got government funds in Quebec that are investing in this company. So this is supported by the Quebec government right there. They've got almost 2 million ounces of gold already in the ground, measured, indicated, and inferred. They've got no debt. They also have several option deals. They're exploring for lithium up in the James Bay region. So I like this category. I like these companies that have a defined asset in the ground. So you've got an anchor there, and then you've got some exploration upside as well. I believe that's the sweet spot. We could look at what this would be in percentage terms to get back to, I mean, they're silly numbers, but you can see the chart. I'm not making up the numbers.
Very good. Yeah, I think these are very illustrative examples. And we've got, I think, just about a minute left. And one thing I would highlight is, you know, you've gone through how you focus on the charts, but when it comes to the juniors, the companies here that you're just talking about, it's charts, but plus all the other elements of due diligence that you mentioned.
Absolutely right. I mean, we can't ignore the fundamentals of the company. The fundamentals are what drive the charts. That's the way that I like to explain it to people. It's just that as human beings, we have to recognize that unless we're insiders with insider information and going to be trading off of that, which is illegal, and then you risk going to jail, so it's not something I want to do. Unless we're in that category, it is literally impossible to know all of the fundamentals. Human beings cannot know all of the fundamentals. So given that, the place where all the fundamentals come together, where we can at least align with the trends in the fundamentals, is in the actual price chart. So that's what I like to focus on, and I hope you follow some of our work. We publish a lot of free articles, free YouTube videos, and hope to speak to some investors.
Okay, thank you very much. This is great.
Thank you, Charlotte.